the reality is that the idea was so bad or so ill-received that the second index fund wasn't started until 1984, 8 years after the underwriting in 1976. And it was also a failure. And the third one went out of business quickly. And then finally by the mid-90s it started to catch on. People saw how it worked, and it was working beautifully by the 90s after a bad start. And it was just a bull market. These large cap stocks were doing very well. We eliminated transaction costs because the index doesn't do any trading. We finally got our costs down. I can't remember what they were in the early 90s, but let's say the cost, you could get one of our index funds for 15 or 20 basis points. And today you can get our S&P 500 index and some of the others with a minimum investment of $10,000 for 5 basis points. You can own the U.S. stock market at a cost of 5 basis points with no additional cost for portfolio turnover. And that is just a return builder when our competitors have, say, close to a 1% expense ratio and probably 1%, half of 1% at least, turnover costs, portfolio turnover, internal costs. And then often offered at a sales charge, which spread over time is another 1%, let's say. So we're operating to give the investor, 7% stock market, 6.95%, and the others taking 2.5 off the 7 are giving 4.5%. Put that on a compound interest table, and you're going to get at the end of 25 or 50 years, maybe 4 times the amount of capital as you have with the costly fund. And this is not just me speaking, Scott. This is Bill Sharpe, the Nobel laureate, and he's been on this game, cost matters game, almost as long as I have. But almost every firm in the industry, but Vanguard, is operated in a way that puts the manager in the driver's seat and not the fund shareholder. This is the way the industry is organized, and the fund directors, even the independent directors, seem powerless to stop it. Maybe they don't know, maybe they don't care, maybe they don't look at themselves that way. But it's amazing that this industry has gone from, I guess when I came into it in 1951, the average expense ratio of a fund, weighted average expense ratio, was probably 50 basis points. And the industry has gone from $3 billion to $16 trillion. And the expense ratio, the average weighted expense ratio, has gone up to, for managed equity funds, to 85. Now, how can that be? Why didn't somebody say, let's give some of these economies of scale, which are enormous in this business, to the shareholders of the funds instead of the shareholders of the management companies? And the management companies are hot stocks. You just track them. There are half a dozen of them, I guess, out there. And with a few exceptions, over time, they do much better than the shareholders of the funds. And I think the industry is going to have to start to think more about mutuality and more about, at least at the minimum, more about sharing, even in retrospect. So it would be a painful thing for the managers. The economies of scale, which are boundless and huge. And that's a big step for the industry to take. The industry won't take it, but one fund will, and then another will. And right now, though, the fees are still as much higher than they were when I came into this business. And they've got to come down because the fees are the difference between investment success and investment failure relative to your peers.
I won't ask you to endorse a competitor, but are there firms out there that don't have a mutual ownership structure that you think do a good job of kind of keeping the costs down for?
Well, I don't see anybody's really doing a good job of keeping costs down. And people that say they have low costs, they're below the industry norm. And the industry norm for the average actively managed funds, I think I said 85. That's a number out of the ICI, taking index funds out of the equation. So if you're at 65, you think of yourself as low cost. For God's sake, Scott, don't compare yourself with Vanguard, who can run the index funds at 5 basis points rather than 65, and run the whole complex at roughly 14 or 15 basis points, counting the managed funds, and that's very low cost. So I think somebody ought to, maybe Morningstar would be willing to do this, and they call them high cost, average cost, and low cost. I think there needs to be a fourth category called very low cost. And there will only be one firm that's in that category. Now, that having been said, if you want to be in the index fund business, you have to have low cost to compete. So Fidelity has very low costs on their index funds, very competitive, totally competitive with ours. But they're, when you think about it, almost the only firm that has a significant index fund business, unless you're an indexer, like BlackRock or State Street, Vanguard, and so on. And so they don't, they have to compete there, but they don't want to compete with the rest of their funds on cost. So something has to happen to bring that down. I mean, it's kind of amazing to think. I mean, I think it's T. Rowe Price that has a bunch of index funds, but they have costs of 20 or 25 basis points. I mean, that seems low, but 25 basis points is 400% bigger than 5. And I honestly don't see how the directors can accept that. And they're, by the way, pretty good on this. You know, there are funds out there, there were at least, that had a sales charge on an index fund of 5% or something, and a 1% expense ratio. So you go into the index fund, you're behind the 8 ball, and every year you fall further behind the 8 ball. Somebody asked people at Wells Fargo how their fund could be so expensive, and this was some years back, and their PR person said, I think forgetting good judgment, said, you don't understand. They're our cash cow. They're Wells Fargo's cash cow. The fund should be the shareholders' cash cow, unequivocally. Did I make myself clear, Scott?
I think I'm getting it.